Okay, students, we're back. Now, I ended talking about the direct method of accounting for cash flows from operating activities. I hope you understood what I was talking about. Most of these categories, you wind up having to deal with some current asset or liability accounts to figure out exactly what's the amount that should be reported here. So, for example, to employees outflows, cash outflows to employees, you would have to look at the accrued salaries and wages payable, and did it go up or down? For interest, you have to deal with accrued interest payable, but you also have to look at premium or discount on any bonds or notes payable, and then you have to take into account the amortization of the bond premium or discount. So you may have interest expense that is higher or lower than the cash amount you paid for interest. So most of these accounts have some current asset or liability involved that you have to look at the change in balance to figure out exactly how much cash was received or paid from those activities. Okay, now we get down to investing activities. Again, they center around assets, acquisition of or sale of usually long-term assets. You could have short-term investments involved there as well, but for the most part, long-term assets. So we have things like uses of cash or outflows of cash for the purchase of land, the purchase of investments. We have cash inflows from the sale of land, the sale of equipment, things like that. That's the total proceeds from the sale of those items. So we sold land for $18 million. That's how much cash we received from selling the land. Okay. Now we move down to financing activities. We see the kind of things that are there. Remember, financing activities are transactions with owners and with creditors. So we have things like sale of common shares, that's sale of our own stock. That's a transaction with owners. Retirement of bonds, that's a transaction with creditors. Payment of cash dividends, payment of dividends is a transaction with owners. So those are all reported under financing activities. Now notice payment of dividends is a financing activity, but payment of interest is an operating activity. The reason is because payment of interest affects income from operations, payment of dividends does not. Payment of dividends is a distribution of net income, not something that's involved in calculating net income. Then we come down here, net increase of cash of $9,000. Then we pick up the beginning balance from the year-end balance sheet of the year before. So that would give us year end last year or beginning of the year this year cash balance. Add the increase in cash, and that gets us down to ending cash balance. Now that should match up with cash from the balance sheet. Now remember, for the statement of cash flows, cash is cash. So cash balance includes cash, it includes cash equivalents, but it also includes restricted cash, which may be a long-term asset depending upon the nature of the restriction. Okay, then we come down here and pick up non-cash investing and financing activities. I'll talk more about those later, but we do have to disclose those. We can disclose them in a note. We can disclose them on the face of the statement of cash flows. Then if you use the direct method, which is what was used here for reporting cash flow from operating activities, then you have to also provide a reconciliation of net income to cash flows from operating activities. So you see cash flows from operating activities were $22 million. So we come down here and see that net income right here was $12 million. So how did we get from $12 million of cash flow from operating activities to 12 million of net income to 22 million of cash flow from operating activities? Well, the reconciliation explains that for us. Now, this reconciliation is basically the indirect method. So if you use the direct method, then you also have to provide a reconciliation of net income to cash flow from operating activities, which is essentially the indirect method. So net income was 12 million. We had a gain on the sale of land right up here. So the sale of land was listed as $18 million here. Apparently we paid $10 million for that land. So we paid $10 million for it. We sold it for 18. That means we had an $8 million gain. Now that $8 million gain was factored into net income, but it is not an operating activity. So we have to subtract out that gain on the sale of land from net income to get to net cash flow from operating activities. Then we see depreciation expense here. Depreciation expense reduced net income, but there was no cash outflow in the current period for that. So we have to add depreciation back. We had a loss on the sale of equipment. That loss on the sale of equipment right here was a factor in determining net income, but it is not a net cash flow from operating activities. So therefore we have to add that back because it reduced net income. We have to take the effect of it reducing net income out of net income to get to net cash flow from operating activities. We come down here and see there was an increase in accounts receivable. Now, what does that mean? That means that there was more in sales than there was cash received from customers. So we included sales, net sales, in net income. So we have to remove that increase in receivables from net income to get to the net cash received from customers. There was a decrease in inventory. So again, that's going to affect cost of goods sold. We sold stuff that we had bought in a previous year that was part of beginning inventory. And so our cost of goods sold was greater than the amount paid for inventory this year because we sold some of the beginning inventory. We reduced the amount of inventory we had by $4 million. So that means that net cash paid for inventory was less than the amount of cost of goods sold. So we need to add back that decrease in an asset. So if an asset increases, we subtract that. If an asset decreases, we add it back because that means there was less cash paid for something than the amount of expense that was reported related to that. Okay, so then we move on down here. So we had an increase in accounts payable. Now, what does an increase in accounts payable mean? Well, most of the stuff we buy through accounts payable is inventory. So it tends to go into inventory, so that inventory, of course, flows into cost of goods sold. So if accounts payable went up, it meant we bought more inventory than we paid for. So we had more reported in cost of goods sold than we actually had cash outflow for. So an increase in a liability gets added back the same way a decrease in an asset does. So we decreased we increased salaries payable, so we had more in salaries expense than we had in cash outflows, so we need to add that back. Then we have a decrease in discount on bonds payable. So you've got to think about how amortizing a discount works. If the discount went down in amount, that means that we reported more in interest expense than we paid out in cash, because part of what went into interest expense was the amortization of that discount on the bonds payable. So we add that back. Decrease in prepaid insurance. So that means we reported more in insurance expense than we paid out for insurance this year. So we add that back. And then, and that's an asset, so a decrease in an asset there. And then decrease in a liability means we paid more out in cash than we showed as expense. So by decreasing income tax payable, then we had to pay more in income tax than we reported as income tax expense. So that means cash flows related to income taxes were cash outflows were greater than the amount of expense reported, so we need to subtract that amount from net income. So we take net income here, we add the pluses, we subtract the minuses, and that's where we get to the $22 million in net cash flow from operating activities, which you will notice is the same as we showed up here under the direct method, $22 million in net cash flow from operating activities. Doesn't matter which method you use, you get the same amount. It's just how you get it is a little different, and the information it provides is a little bit different. Now, I want you to think about this for a minute. There are two methods, the direct method and the indirect method, for providing cash flows from operating activities. Now, which do you think is the preferred method? So I'll let you think. You can pause the video and think, or I'll just let you think for a few seconds. Okay, now the answer is the FASB has come up and said the direct method is the preferred method. Now, the reason they've said that is a lot of financial institutions have said that they prefer the direct method. It provides them information about cash flows from customers and cash outflows, exactly where that cash flows. So that's the preferred method. Now, which of the two methods do you think is the most commonly used? Now, the answer is that the indirect method is more commonly used. In fact, a survey of 500 corporations, only 1% or 5 of those use the direct method. The other 495 use the indirect method. Now, your book talks about why that is. You know, there's a couple of simple reasons. Number one, and I think the most important, is if you use the direct method, the preferred method, you also have to do the indirect method. If you do the indirect method, you don't have to do the direct method at all. Because if you do the direct method, you still have to provide this reconciliation of net income to net cash flow from operating activities. That is one of the stupidest things the FASB's ever done. The second stupid thing we'll talk about later in the chapter, maybe on the next video, or it may be the one after that. But I'll get to that in a little bit. But my time is about running up, so I'll stop this video now, and we will pick up here in a few minutes.